Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
For the most part, I'm going to be buying my options in these two market cycles, sideways market cycles. But then again, I have a situation like I do right now in the CDD, in the dollar Canada, where this is arguably a markdown, perhaps the beginning of distribution, perhaps a transition into distribution. And if that's the case, this is probably perfect timing to start thinking about the two scenarios that I've just explained and think about how I want to position myself around parity and the time that I want to give myself. I think right now playing the bounce from parity is a good near-term strategy. Playing that bounce is a good near-term strategy. In other words, I don't need a lot of time. I don't need a really far-out expiration date. I can buy an option a little bit less time. You know, obviously, you're going to pay for time. Okay. I can also start thinking about the further out puts. Okay, those further out puts for maybe that midsummer push through parity. Okay? So hopefully one of those two scenarios will lend themselves well to your current approach to CDD, and this also gives you a good idea of how to use the market cycles, how to use that understanding of the volatility per day in the different pairs, to understand what a quiet day is, what a volatile day is, based upon the historical pip movement ranges. Okay, and also we talked about a little bit earlier on. I was going to mention cross-market correlations and how crude oil, I think, is going to be a big factor in what happens with the Canadian dollar and how you're going to position yourself with a CDD midsummer. So near term, I think the bounce, the calls are probably your more reliable setup. I think in about 30 to 45 days, that's going to shift into playing puts that don't expire until probably July, end of July. We'll even look into August. Okay? All right, so I'm going to go ahead and take a look at any questions that have popped up, because I did not put my chat window open. So let's take a look at my chat window here. All right. Let's see. Does anybody have any questions? I'm not sure if I'm looking at the right section here.
I see, Raghee. Here's one. How do you weigh risk? Are you protecting margin risk, pair, or a commodity? And I guess, it's a general question. When you're looking at the spot, you're looking at a currency option. How would you decide one versus another? And then, what's appropriate as far as risk? How does one, of course, everyone's going to have a different risk-reward profile, but how do you look at it, Raghee?
As far as risk reward, I'll tell you, if I'm looking at the options here, I don't use a percentage or a dollar-based decision. To me, every trade has what I call a point of validity. In other words, there's a point at which the reason for my trade is no longer valid. So if I knew all the elements that made my entry valid, there's got to be a point at which the entry is no longer valid. So for example, using the CDD here, if I was looking at that call strategy where we feel near term there might be bounces, continued bounces along 1.0 until crude oil starts to rally for that summer rally, really I take a look at the near term lows in this market okay, which seems to be more or less positioned around 99.50, 99.49. So for that rally, for that bounce to be valid, I prefer prices to stay above that level. Now, what that means in terms of a risk/reward, well, again, just like I'm using support and resistance, again, the parity level is my support or resistance, depending on which side of it we are. Right now it's support. The 1.0 really isn't the decision level. It's actually this 99.50 area. So if we break 99.50, there's probably a pretty good argument that the sentiment is going to shift, number one, to a much more negative or bearish mood. And that's where I want to say, well, if the bounces aren't coming off parity, if the bounces are not are testing 99.50 and possibly now breaking it, that's what I want to get out. That's for this call strategy. As far as for the potential upside movement, I'm going to use a combination of two things. Sometimes a single day can have so much volatility. It's not even necessarily the intrinsic value that I'm looking to take advantage of, but now it's the fact that, for example, the dollar Canada moved 181 pips, when on average it's somewhere between 70, 110, 40, and 70 on average. So if I had a CDD call and I see a day like this, I'm probably less interested in any kind of resistance level and much more interested in the fact that the volatility was so high compared to what it normally does. I want to take advantage of that and go ahead and liquidate, not necessarily all my options, but at least some of them I want to go ahead and take some money off the table. So it's a combination of recognizing where support and resistance are, but also it's taking advantage of that volatility aspect of the option and seeing that if I'm so far above normal pip movement, it's probably a pretty good idea to go ahead and take a little taste. So support and resistance will definitely be a part of it, but also pip movement will certainly play a role, especially when I'm looking to liquidate on the profitable side. So hopefully that helps there.
Oh, definitely.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.